Chapter 8, Fraud, Internal Control, and Cash. Petty cash funds are maintained to pay relatively small amounts and involve establishing or setting up the fund, making payments from the fund, and replenishing the fund after cash has been spent from the petty cash fund. The employee who is the petty cash custodian is responsible for maintaining control of this cash. The journal entry related to establishing a petty cash fund for $100 on March 1 results in a new asset account titled Petty Cash. Therefore, because assets increase with debit, the asset account Petty Cash is debited. Because the regular cash account has been reduced, the cash account is credited. When the cash remaining in the petty cash is only $13, the cash that has been paid out or reduced is $87, that is, 100 minus 13. The $87 reduction should be supported by receipts, in this case, postage for $44, freight out for $38, and miscellaneous expense of $5. The journal entry to record the replenishment of the $87 is to debit the appropriate expense accounts, postage expense of $44, freight out of $38, and miscellaneous expense of $5. Because cash has been reduced, the decrease or credit will be recorded to the cash account. If the petty cash custodian has made a mistake, the reduction of cash will not be fully supported by the receipts. If there is only $12 left in the petty cash fund, that means that $88 instead of $87 is gone. The first part of the journal entry will be the same as in the previous slide. Debit postage expense, freight out, and miscellaneous expense. The decrease in cash is $88. At this point, the journal entry is not in balance. Total debits are $87 and credits are $88. Because $88 is gone and the receipts only support $87, there is a shortage of $1, which is recorded to the account cash over and short. Now the journal entry is in balance with total debits of $88 and total credits of $88. Companies agree or reconcile their cash account balance with what the bank reflects as the cash balance. The reconciliation process involves examining information from the bank statements. We have learned that cash increases with debits, but banks' debit memorandum include reductions to the cash account. Banks commonly reduce cash balances by bank service charges and identify checks from company customers that have been deposited as NSF, not sufficient funds. When companies collect check from their customers, they will not know which company's checks will bounce or have insufficient funds to cover the check. Banks' credit memorandum include increases to the cash account and can include notes receivable due to the company collected directly by the bank or interest earned on an interest-bearing cash account. The reconciliation procedure involves identifying amounts that differ between the bank and the company's books and making adjustments to arrive at correct balances that agree. The bank balance from the bank statement is the starting point. Adjustments to the bank involve timing differences, adding deposits in transit that are usually deposits the company has made at the end of the month that the bank does not record until the following month, and subtracting outstanding checks that are checks that the company has written but have not yet been presented to the bank for payment. Adjustments would be necessary if the bank has made any errors. Adjusting the bank balance results in a correct balance per bank. Next, the company's books balances will be adjusted. Company adjustments include adding notes receivable collected directly by the bank, subtracting NSF checks collected from customers, subtracting bank service charges, and adjusting for any company errors, Adjusting the company's books balance results in a correct balance per book. This correct amount per books should equal the correct balance per bank. The illustration includes the bank cash balance, the company's books cash balance, and the following reconciling items: deposits in transit as of the cash balance date, outstanding checks, a company error of $36, which is calculated by taking the difference between the correct amount and the incorrect amount recorded, and bank memoranda, which include an NSF check, a bank printing charge, and a collection of a note receivable, resulting in an increase to cash of $1,035 that is calculated by taking a note receivable of $1,000, adding interest earned of $50, and subtracting a bank fee of $15. The bank reconciliation is prepared here. Let's first adjust the bank balance that is given at $15,907.45. There are almost always two adjusting items to the bank balance: deposits in transit and outstanding checks. The deposits in transit are added and the outstanding checks are subtracted. If there were any bank errors, those adjustments would be presented next, but this example does not have any bank errors. The adjusted cash balance per bank is $12,204.85. Next, the company books cash balance of $11,589.45 will be adjusted. The $36 error related to check number 443 will be added as a reconciling item because the company recorded the check or reduction to cash as too big. The other addition is the $1,035 collection by the bank of the note receivable. The NSF check will be subtracted, and the bank printing service charge will also be subtracted. This results in an adjusted cash balance per books of $12,204.85. This book's adjusted amount must agree with the bank's adjusted amount. Journal entries from the books adjusting section of the reconciliation will be prepared so the cash account will reflect all necessary activity. The reconciliation on the last slide contains 4 reconciling items in the books adjusting section. Therefore, the company will prepare 4 journal entries. The first item in the books adjusting section is the correction related to check number 443. The correcting entry will contain a debit or increase to the cash account because the $36 was added in the reconciliation. Because check number 443 was written as a payment on account, the credit is to accounts payable. The second reconciling item was another addition involving the collection of a note receivable. The journal entry will include a debit or increase to the cash for $1,035, the amount from the reconciliation. The bank collection fee is an expense, so it will be recorded as a debit to miscellaneous expense. Because the note receivable, an asset, has been collected, it is necessary to decrease it, and assets decrease with credits. Because the $50 interest earned has not yet been recorded or accrued, the revenue will now be recorded as the credit. Note how debits of $1,050 equal credits of $1,050. The 2 remaining reconciling items are subtractions on the books section of the reconciliation. Because cash decreases with credits, each of these journal entries will contain a credit to cash. The NSF check represents a collection from a customer whose check bounced. Therefore, it is necessary to increase the customer's account for that amount to reflect the balance is still due from the customer. The accounts receivable, an asset, increases with a debit, and as mentioned previously, the credit will be the cash account. The bank printing charge for the company's checks will be recorded as a debit to miscellaneous expense, and to reduce the cash account, there is a credit to the cash account.